The United States national debt has reached $36 trillion. This figure now exceeds the total annual economic output of the entire country. Distributed across the population, that total represents more than $100,000 of debt for every American citizen. This accumulation is driven by a persistent gap between revenue and obligations. The government consistently spends more on Medicare, Social Security, and defense than it collects in taxes. While deficit spending has sustained the American economy for decades, the current scale of borrowing has moved the national balance sheet into uncharted financial territory. The cost of servicing these balances creates a more immediate risk than the raw size of the debt itself. For years, near-zero interest rates allowed the government to carry massive debt loads with minimal costs. To combat recent inflation, the Federal Reserve raised interest rates, which made every dollar of new government borrowing significantly more expensive. Annual interest payments now exceed $1 trillion, capital that is drained from the budget without providing any public infrastructure or services. Crossing this threshold transforms the national debt into a parasitic drain on the economy, requiring more revenue just to maintain the status quo. The government secures its funding by issuing and selling Treasury bonds. These bonds function as government IOUs. An investor provides cash today in exchange for a guaranteed repayment with interest at a later date. The buyers of this debt include pension funds, insurance companies, and foreign governments. Historically, the global market has viewed these bonds as the safest asset available, operating on the belief that the United States always meets its financial obligations. This psychological trust from investors is the essential foundation for the entire U.S. funding model. Disinvestor confidence slips, they demand higher interest rates, or yields, to offset the perceived risk of holding U.S. debt. These higher yields immediately increase the government's borrowing costs. As interest payments consume a larger portion of the budget, the annual deficit widens. To bridge that gap, the Treasury must issue even more debt, which can drive yields higher and restart the cycle. This feedback loop accelerates when major foreign holders, such as the People's Bank of China, reduce their dependence on U.S. assets. This creates a self-sustaining cycle where the cost of debt forces the creation of more debt, independent of tax revenue or economic growth. The presence of this spiral raises the question of whether the United States will eventually default on its loans. A technical default is unlikely because the U.S. government maintains control over its own currency and can create the dollars necessary to pay its bills. Instead of bankruptcy, the risk is a massive increase in the money supply, which dilutes the value of all dollars currently in circulation. This inflation erodes the purchasing power of citizens, resulting in higher prices and devalued savings. This systemic inflation acts as a continuous tax on the public, reducing the real value of the debt at the expense of those holding the currency. Because the U.S. dollar is the primary medium for global trade, this domestic instability is exported to international markets. A loss of confidence in the dollar would manifest as extreme stock market volatility, rising global interest rates, and financial pressure on emerging economies. The global economy now faces three potential directions: a return to manageable levels through growth, a long-term inflationary burn, or a sudden disruptive debt crisis. The monetary and legislative choices made over the next decade will determine which of these outcomes becomes reality. As the U.S. dollar underpins the international financial system, the management of this $36 trillion debt is now a central factor in global economic stability.